Hello and welcome to Forex.Academy, the #1 website for Forex and crypto education and analysis. In today's edition, we are going to be discussing market analysis. The Forex market dances to the beat of its own drum. Unlike investing in the stock market, where stock prices tend to go up and down depending on the performance of an individual company, the movement of currencies in the Forex market is much more complicated. For example, all currencies are traded in pairs, such as the British pound against the US dollar, or the euro against the pound. Therefore, not only do you have to be fully aware of the fundamental economics of one country's currency, you also have to be aware of the fundamental economics of the other country's currency of the pair you are trading. The two styles of investment are like chalk and cheese. When it comes to knowing the Forex market, there are three major factors to consider when trading: fundamental analysis, technical analysis, and market sentiment. Let's look at these three in more detail. Fundamental analysis is the way of studying a particular country's currency by analyzing economic, social, and political forces in order to gauge the current and future outlook of that country's economy, and therefore the current and future strength of its currency. Technical analysis is the study of price movements of a particular currency via the analysis of charts, and where certain technical tools are used in order to study historical price action in order to predict future price movements. Market sentiment is the overall feeling that traders have regarding a particular currency and where that sentiment might be in contradiction to technical and fundamental analysis of a currency, and may therefore cause the trader to abstain from a trade or to trade against his or her indicators, even though the technical and fundamental indicators are telling him or her to pull the trigger. A good example of market sentiment would be that at a time when the British pound is currently being bought against most of the other major currencies, including the US dollar, the euro, and the Japanese yen. Even though the fundamental indications are that Britain's economy is slowing and could be exiting the European Union at the end of this month without a deal, which could be catastrophic for the British economy, technical indicators also show that the pound could move further to the downside, especially against the US dollar. However, the current market sentiment is that Britain may find a last-minute deal in order to exit the European Union with an agreement in place. This would be very good for the British economy in theory, and therefore the pound. So, if the three pre-mentioned components are the major drivers for the Forex market, we should be good to go, yes? Unfortunately not. If only it was that easy. Market sentiment also changes from region to region. For example, the Asian region may have a different market sentiment or outlook from the European or American regions, depending on those markets' industrial and commercial sectors and their economic activities, including the buying and selling of commodities and goods and services. Also, the Forex markets operate 24 hours a day, 5 days a week from Sunday night to Friday night GMT, and market volume and volatility varies from region to region. As a note of caution, a trader opening a trade at 9 p.m. GMT based on his or her technical analysis, just as the American session is fading and before the Asian session opens, runs the risk that market sentiment in the Asian area might be contradictory to the US region and therefore adversely affect the outcome of their trade. Here is an example of how to have a better understanding of trading activity and currency volumes and volatility in various time zones. Traders are fairly predictable creatures, and most traders work for banks or large financial institutions. These ladies and gentlemen are able to independently move the market with their trade size, which is much greater than that of retail traders. A retail trader might typically trade a few pounds or US dollars per pip, whereas an institutional trader will be in the hundreds of thousands, if not millions per pip. They are usually paid large salaries and are all under pressure to make money for their firms. Therefore, what we usually see is greater volatility in the Forex markets when they arrive at their desks, and especially at the beginning of a new session in a particular region, because the traders are fresh and eager to take advantage of the regional time crossover. Another time of increased volatility and currency volume in the market is during periods of economic data releases in various countries. Price action during these times can be extremely volatile, and the reaction of the market can often fly in the face of market sentiment, technical and fundamental analysis, as traders try to decipher economic data release information and how it may impact the currency's exchange rate. If you enjoyed the video, please like and subscribe, and comment down below if there's anything you'd like us to cover in future, or if you would like to discuss the topics we have covered. Have a great day.